There are over 3,000 ETFs only in the US trading. But there is the truth they don't tell you on financial social medias or TV. And that is that 80% of all investor money is sitting in just 50 of them. And these 50 funds represent over $4 trillion in capital. They are the pillars of modern investing. Some you know, and some you think you know. And a few are hiding in plain sight. Today, we are not going to count them down like a billboard chart. No. We are going to decode them. We are going to group them into 4 pillars. So we have the titans, we have the specialists, protectors, and the hybrids. And along the way, I'm going to show you the data that most investors miss. The stuff you can't see unless you know where to look. Heads up, pen and paper, have a pen but no paper here. Get them ready because a lot of abbreviations are incoming now. And I'm not joking. Pillar 1. Let's start with the titans. These are the funds with so much capital that they can move markets. They are your core building blocks. We have 3 S&P 500 ETFs right here. That is SPY, SPY, IVV, and VOO. They track the exact same index. So why own one over the other? I will explain it to you. SPY has the highest volume, over 70 million shares, and that's in a day. That makes it the choice for option traders and day traders. IVV and VOO trade less, but they cost also less. And here is the detail they don't mention. SPY distributes its dividend differently. It pays out cash that sits, while IVV and VOO reinvest faster. So over 30 years, that friction that costs you. The vehicle matters, not just the destination. Now look at VTI versus VOO. VTI holds 3,600 stocks, while VOO holds 500. And look at the correlation, 99%. So why own the VTI? Because every year a few small caps, they break out and become a new next big thing. The VTI catches them automatically, while VOO makes you wait until they graduate to the big leagues. And then there is the global perspective, VEXUS or VXUS. It covers the world excluding the US. Next is IEFA, focuses on developed markets. VEA is another developed market heavyweight. And pairing any of these with the VTI or the VOO gives you a true global equity portfolio. And that is the foundation. The titans also include QQQ, which tracks the Nasdaq 100. It's the tech heavyweight. And for this, it belongs actually under pillar number 2. But it also includes companies like Pepsi or Costco because of the Nasdaq listing rules. So we can put them here as well. Pillar number 2, the growth specialist. So actually we have the QQQ, that is the tech heavy, but remember it includes consumer names because of the Nasdaq rules. Then we have XLK. It's a pure technology stock, following the official sector classifications. So if you want to have pure tech exposure, XLK is your scalpel. Then you have the style boxes, IWF for the Russell 1000 growth, IWD for the Russell 1000 value. See these two differences, because from there we go to the VUG and the VTV from the Vanguard, and they do actually the same thing. Growth has outperformed for years, but value has its moments. If you own both, and you own then the whole spectrum. Now, the income specialists, the SCHD and the VYM. These are the giants here, but there's a difference. VYM focus on high yield, and it is heavy in financials and the consumer staples. SCHD focuses on the dividend, growth and quality screens. So look at the 5 years dividend growth rate. The SCHD crushes the VYM here. So if you are 65 and you need cash flow now, VYM might be your pick. But if you're 45 and want growing income that outruns inflation, SCHD is likely a better fit. Somehow I belong nowhere. Then you have the size plays. IWM for the small caps, IJH and the MDY for the mid caps. Small caps have higher long-term returns, but more volatility. The mid caps are the sweet spots, less volatile than the small, but more growth potential than the large. And of course, the sectors. XLV for healthcare, defense and innovative. XLF for the financial, rates up, then the banks will win. XLU for utilities, boring, but yeah, they pay the dividends and hide during the downturns. XLE for energy volatile, but when oil moves, this moves too. VNQ for the real estate commercial property without buying any building. And finally, emerging markets, IEMG and the VWO. It gives you China, India, Brazil, and the rest of the developing world. Higher risk, higher potential reward. They have lagged actually recently, which means also they might be due. Then we have pillar 3, the protectors. So the titans and the specialists are your offense, and the protectors are your defense. For the last 50 years, bonds were, let's say boring. But recently, they became more volatile. So you need to know what you own. Look at BND. It's a total bond market. Everyone owns it. But BND has an average duration of about 6 to 8 years. And that means if interest rates they will rise 1%, the BND drops roughly 6 to 8%. Scared yet? Don't be. Just you need to understand the tool. Now look at SHY, SHY, a short-term treasury. Duration is under 2 years, much less sensitive to rates. And if you are adding bonds for safety during a hiking cycle, SHY is your umbrella. Less sensitivity and less drama. That's a good name, right? SHY. TLT is the opposite. It's a long-term treasury. Duration over 20 years. When rates fall, TLT soars. When rates rise, TLT gets crushed. It's a trading vehicle, not a set it and forget it position. LQD is an investment grade corporate bonds. Companies with a solid balance sheet. We have HYG, it's a high yield young bonds. Higher yield, higher risk of default. In a strong economy, the HYG performs. In a recession, it gets hit very hard. And then there is gold, GLD and IAU. They track the same metal. IAU has a lower expense ratio. GLD has more volume. Gold doesn't pay dividends. It doesn't have earnings. It's just a store of value. Look at this. During the COVID crash, equities dropped 30% in weeks. Gold held steady. When the financial system gets a sort of hiccups, gold often rallies, or at least it holds. It's not an investment, it's an insurance. So you don't insure your house, right? And hoping it will be burned down. So you insure it to case it does. And finally, TIP. It's not a real TIP, it's a treasury inflation protected. These adjust with inflations. You are worried about purchasing power erosion. TIP is your hedge. Pillar number 4. Now we come to the hybrids. These are the tools for specific jobs, the scalpel traders. You've got thematic innovators like ARK, ARKK. It's actively managed. It means that a team of people, led by Katie Wood, actively picks the stocks they believe it will perform. So its primary theme is disruptive innovation in companies all over the world, but mostly in the US. Then you have funds like ESGU and SDG for values aligned investing. ESGU screens for environment, social, and governance factors. SDG targets the UN Sustainable Development Goals. They are called the ESG ETFs. Then you have got the currency hedged internationals. We have the DBEF and HEFA. Those two give you developed markets exposure, but strip out the currency fluctuation. If you think the dollar will strengthen, these protect you. But if you think the dollar will weaken, you are better off with another one, the unhedged funds like VEA. You've got targeted the thematic plays. ICLN for clean energy, solar, wind, the whole ecosystem. TEN for pure solar exposure. LIT for lithium and battery tech, the raw materials powering the electric vehicle revolution. ROBO for robotics and automation factories of the future. And then you've got the new wave of AI adjacent funds, IVES. It's the Dan Ives Wedbush AI revelation names after the famous tech analyst. And then we have AIPO, targets the AI and also the power infrastructure. DRNZ, it's literally drone ETF. And yes, the KOID, it's real. The Crane Share Global Humanoid and also Embodied Intelligence. Humanoid robots, that is the thing now. And finally, the leverage tools, TQQQ. It's the 3 times leverage of QQQ, so more or less the Nasdaq. The SOXL, it's 3 times the leverage of the semiconductor fund. These amplify these indexes times 3. These are for the shorts, not for the long. They are for the short-term trades because the long-term they hold. Decay is real. Read the prospectus seriously. These 15 hybrids matter, but they are not for everyone. Use them when you have a specific thesis. Don't let them become your entire thesis. Be careful with it. So let's do a quick accounting. We have covered the titans that are the core builders. We have the specialists. This is the sector and income players. Then we have the protectors. They are the ballast and the insurance and the hybrids, the thematic and the leverage tools. That's 50 funds, the whole complete set. The ones that hold 80% of all investor money. The point is this. You don't need all 50 ETFs, of course. You need to know which of the 50 fits your job description. How do you use this? Let me give you 3 blueprints, not portfolios, blueprints. A framework you can maybe adapt for yourself. Blueprint number 1, the core 4. So we have 60%, for example, VTI or VOO, the US total market, or S&P 500, it's your choice. 20% VX US, and total international. 20% BND or AGG, a total bond market. You can call this the Bucklehead Special. 3 funds, total global diversification. You can retire on this, you can raise kids on this, and you can ignore the news on this. It's not very sexy, but it works. Blueprint number 2, the dividend compounder. Let's say 50% SCHD, it's a dividend growth, 30% VYM, high dividend yield, and 20% LQD, it's an investment grade corporate bond. This is, let's say, for the cash flow seeker. The goal here is to wake up, let's say, every quarter and see the deposit lands in your account. Then blueprint number 3, the global growth engine. 40% QQQ, the Nasdaq giants. 30% VEA, the developed internationals, 20% IEMG, the emerging markets, and then 10% ARK, ARKK, a thematic bet. This is a quite aggressive fund, but this is for the investor who believes that the next decade belongs to technology and also the emerging consumer classes. It's volatile, it will test your nerves, but over long periods of time, this has been the compounder's path. So we have 3 blueprints and 3 totally different relations with risk, and which one will fit you. That is not a question I can answer for you. But now you have the tools, and I hope you made some notes as well, so you can answer this by yourself. The 50 ETFs we covered today are not only tickers. No, they are the collective wisdom and sometimes the collective delusions of millions of investors. And your job is not to buy them all, your job is to know which ones belongs to you. If you have maybe some questions, leave them in the comments. And if you think this was an interesting video for you, please subscribe so you can see more of this kind of videos. Thank you for watching and see you next time.